Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. And today, guys, quick update as to the Etoro portfolio. This is a publicly available portfolio that I am in charge of, which you can copy with your own funds. If you are unaware of how Etoro works, link in the description, you can read up more about it. Very, very good initiative, very good brokerage that you can use for no commission. So disclaimer, obviously, none of this is advice. It's just my opinion, what I'm doing with my own personal funds and the funds that I control. So quick update, guys. In November, a little bit of volatility. We finished the month up 2.7%. If you're an international investor, I want to add in that your dividends in US dollars are not recorded in this performance tracking, which really hurts me because I invest a lot in free cash flow and deep value basis. But nonetheless, be that as it may, if you account for dividends and if you account for foreign exchange, that number starts to look a hell of a lot better than 14%. So we get back into still in the negatives, but in single digits for this year. We had a monster month with October, as you can see, very heavily geared towards the commodities sector, in particular energy. Not going to go into a massive breakdown, guys. I've set up the portfolio. This is a longer term portfolio based on value investing, and we have been receiving recently, since the second half of the year, about 1.5% monthly in dividends as alone as a return. So it's just about staying patient and staying the course here. Strategy is working well. A few mistakes at the start of the year didn't cost us much, thank goodness, but willing to admit those and rearrange the portfolio. And I think that we're sitting in a good position. So before I go into the weightings of the equities, I want to draw this to your attention. Nearly 22% in cash. So a lot of cash sitting on the balance sheet, waiting for what I believe will be a return into a downswing in the bear market. We'll come back to the individual positions in a moment. I just want to point out, recently we've seen this absolute bear market rally, if ever I've seen one, here on the S&P from 3942 up above 4,000 points. If you look at the verticality of that, that is not a sustainable grind upwards. That's very, very unnatural. And I think that you will start to see that give back most of those gains, if not all. So S&P broad index, if we look over this year, as a percentage down 9.61, which is obviously very annoying if you're holding a double-digit loss on your balance sheet as mark-to-market, but we don't play for 1 year, we play for many years. And it would be slightly ahead of that, as I mentioned, taking back the dividends into account. So here's a really key point. As you can see, the close on the candle came up. It bounced off that 200-day moving average. I believe that we will very likely start to see that dip lower. And once we get below the 200-day moving average, then that is typically a very bearish technical sign. And we will see last time, as you can see here, across the 200-day moving average, what happens is on Wall Street, the algorithms, the computers, the robots that are trading these indices, particularly using the options market, they just go into an and/or mode. So they're binary. They just get below 200 moving average, puts various algorithms into a lot of selling pressure. And so you can see that very steep day here, bring that back up, was the last time it crossed 200-day moving average. And we saw a very, very steep regression. To give you an idea, that was a very, very steep regression from +5, and we troughed out there. So about 14 to 15% drop over a month to 6 weeks. And once we hit that 200-day moving average drop. So we have a short position in the portfolio. It's not a big one. It's not designed to make a hell of a lot of money. It's just designed to have some cash there as that market starts to pull back, where prices are lower. So our other positions will likely be sold down a little, and we can get back in and increase more positions in the stocks that we like at lower prices, ideally. So there's the S&P. And next thing that I want to bring to your attention is what's causing my bearishness. In a word, it's Fed. Okay, the Fed are causing that. If we look here over the year, we've seen the increase, take that off percentage points, in terms of the Fed funds rate from practically 0 to 3.75. If I hide the S&P here, we can see as a percentage, obviously that's out of this world. If you notice the steepness in the Fed funds rate, is the cost of money for most of the most of the commercial banks essentially, and the cost for the US government. So from here, this is the first ripple in the ripple effect as the interest rates start to rise. And so as rising interest rates act like gravity on most asset prices, because why would you invest in a stock that's going to pay you a 4% dividend yield, 4% earnings, when you can get 4% guaranteed by the US government? Essentially, I know this is the Treasury, but for to keep things brief, that's basically how you want to think of things. And if we look over here at the 10-year, okay, so here we're starting to get an inversion, okay, inversion. So whenever we start to see that's a very, very strong recessionary indicator. If I get rid of the Fed funds rate for a moment, this is the 10-year, okay, for the US Treasuries. You're getting 3.5% yield, lending money to the US government essentially for 10 years. Okay, so they give you, or $100, they give you $100 back in 10 years, and accumulation of 3.5% interest rates as of today if you use the variable rate. We've been above 4 this year. Okay, and if we start to look at, I wonder if I can make noise. So if we start to look at this, we should see this have a margin against this. Okay, so the Fed fund, the Treasury should trade for more than the Fed funds rate in theory. If you're borrowing short term, then you need to be able to lend out at a longer term rate higher than your short term, or you're literally losing money, a guaranteed loss of money year in, year out. So when we start to see this, this yield in the 10-year dropping below the Fed funds rate, that means that yield curve control looks like it's being applied, where the central banks are really the only ones buying up these 10-year bonds of the government, which is bringing their yield down. So you've got to think about it. If you have interest today for the Fed funds, the cost of the US government at 3.7%, and then the US government is paying out 3.5%, they're losing that 27%, 27 basis points spread. So it makes no sense. It's a sign of a very, very sick credit market. So when it comes to the Fed funds rate, if we get rid of the 10-year for a second, people are expecting somewhere around 4.75 to 5, if you believe Jerome Powell. And the article I put out for the ROI Club members goes into detail as to why that is. Let's say it's 4.5. That gives us maybe 2 to 3 more Fed meetings of rate hikes, depending on how aggressive they want to be. They've said that they will slow the pace of the hikes, but they'll continue to hike, and then they will pause longer than people think. I think there's a lot of people out there and clearly, if we look at the S&P with that rally, that think that the Fed is just about to pivot whenever they soften their rhetoric. It's not necessarily the case. So we need to be a little bit smart about that, a little bit cautious, waiting on the sideline. So what do? We've got some cash allocated, we've got some hard assets, we've got good dividend and high free cash flowing stocks. And mainly, we find those in the energy sector as of the last 18 months. So let's take a look at the big daddy of them all, the oil price, the crude oil price. And this is absolutely bizarre, and this is why finance is often so tricky. If you look today, crude oil is dipped below the cost of crude oil in January, and then just after February, where the 24th of February, the war or the invasion was initiated in the Ukraine by the Russians, and all the disastrous impacts that is still having and still going on to global supply chains and global trade initiatives, and yet somehow the crude oil is trading on the open market for front month futures contracts at a lower price, given all the supply disruption that we've had. That makes no sense whatsoever to me. People are afraid of a recession, fair enough, that will dampen the demand growth. But as you will see, if you look at my interview with Shabam Garg, really the oil guy, go-to guy for me, explaining that the only time we've seen a reduction, a brief transitory reduction in aggregate demand, was in a recession as bad as 2008. And so obviously that's a very high hurdle over which you would need to jump as an oil bear. And then if you look at the years straight after, it more than compensates it. So GDP is oil consumption, okay? And oil consumption is GDP. There's no separating. So we go into recession, sure, that you might see this soften a little bit. But if you think about the amount of oil inventories, and last month Last week, HFI put out their tracking graphic data showing a 10 million barrel draw in US crude inventories. So we have really gotten to some crunch points here. The SPR and China being locked down have been what's kind of kept this under control in the sense we've still had draws going on, guys. Okay, this is not sustainable by any means. But if you've added another 2.5 million barrels from the SPR, and then you take away 2.5 million barrels of demand by locking down continental China, that's how we've been able to avoid a massive squeeze that people were expecting back around March when oil got up to well above triple digits. I don't believe this is sustainable. I think this is a pullback because now the US midterm elections are over, so no one needs to really pump out the SPR to put it on the global market to keep the voting constituents happy. And we have rumors, they are rumors of China reopening. So that would essentially bring that back to a gap of, who knows, 3 to 5 million barrels a day. It'll be a big gap, we know that, at a time when inventories are very, very low. We also have this phenomenon in Europe where we're expected to have a lot of gas to oil switching for industry. That could add, if you look at Josh Young's work, anywhere from 650 to 800,000 barrels a day worth of demand. And then we got Russian crude will come offline tomorrow officially because it's the 5th here in Australia, and it will be the 5th in the US tomorrow, Northern Hemisphere, most parts tomorrow. So Russian oil will be officially offline. Obviously, it will still find its way to various other places around the world that want it. But that leads me to the next position that I will be building out, which is a position in tankers specifically, because I think these guys are going to do very, very well with the uptick in demand for crude transportation across the ocean. So that's that, guys. Anything else that I want to show you? Maybe just the dollar index versus other currencies before we whiz back to the portfolio. But the Fed meeting in December, I think they're just going to hike by probably 50 basis points. Who knows? Who cares? We're getting, we've got that sort of 5% target in mind. And it'll be interesting to see where the 10-year ends up as a result of the Fed funds rate. So the dollar index has cooled off. Now, you may remember, where's the EMA on this thing? Anyway, it doesn't matter. That I had made mention that the dollar index, when it got to around the point of the 200-day moving average, dropping back, would be a very, very interesting entry point for entering into emerging markets. Okay, so I can't really be bothered today, but we're going to look at the 200-day moving average for that. If I bring it up here, we might be able to get it. And so I'll be keeping an eye on that. We do have exposure to energy producers over the world, and so I don't know what's happening to the 200-day moving average, guys. So sorry about that. Anyway, here I will be just looking to keep an eye on where this dollar index, here we go, is. We are getting fairly close here. The dailies we want to go into, come on guys, weeklies, we're not quite there. And if we go to monthlies, it'll be interesting to see where we fall. So we're getting pretty close there in terms of the indicators for 200-day moving average. So we're not quite there, but it's starting to look very, very interesting for me to increase my positions in particularly Brazilian stocks, which is an economy in which I'm very, very bullish at the moment. So enough squiggly lines. Let's take a look over into the portfolio. Where are we? Long-term uranium is a big key tenet of the portfolio for reasons that I've spoken with and interviewed many, many people. We've got a met coal, coking coal, industrial coal, if you want to think of it that way. Super cheap resource play in Arch Resources, paying out dividends and cash backs. I think coal is going to do very, very well, particularly on China reopening. We have a large allocation to Callum Petroleum in particular because it is our largest US play. has a lot of good acreage, extremely cheap, trading barely at book value in my view, and I think that Callan is one of the main ways I wish to play it. GoPro I've spoken about. Synovus, again, fully integrated oil company in Canada, so we've got our exposure on the other side of the border. Playing the agricultural thesis mainly via fertilizer stocks, Mosaic, and then CF Industries is a heavier position because it's run up so much, and we've done very, very well. Here we have two key players in the emerging markets. So we've got Ecopetrol, which is Colombian, fully integrated, a very, very cheap producer, and Petrobras, which at $50 Brent can still continue to crank out double-digit dividends. I mean, you think about how cheap that is. It's truly insane. Shipping hasn't been my friend this year, but we see day rates bottoming out for most containers. Danaos has a hell of a lot under contract, and it's trading, I believe, at 50% of its value at the moment, easily. So no one else seems to be seeing the value. That's totally fine with me. Short position in the S&P is probably the only other little thing to point out here. The rest is very, very small positions waiting to be built out when I believe the time is right, with our 22% cash. So I will be taking a position in Frontline to gain tanker exposure, and that's probably the main piece of news for you today. Having said that, guys, any questions or comments, leave them in the description, and I look forward to catching up with you in another video shortly. Cheers.